How to handle a large sum of money. The simple three-bucket strategy 1. The purpose of money and why planning matters. Money is not an end in itself. It should make your life easier, create freedom, and provide security. Paradoxically, the opposite often happens. Stress, uncertainty, fear of mistakes. Many who suddenly come into money feel overwhelmed. At the bank, the conversation turns to risk disclosure, product categories, and return expectations, but rarely to the actual purpose of the money. In reality, every investment decision comes down to 3 things. 1. How long will I not need this money? 2. What level of fluctuations can I emotionally tolerate? 3. And what return matters to me for that? If you answer these 3 questions clearly, you can build any financial plan, whether you have 50,000 euros, 500,000 euros, or 5 million euros. 2. The 3 asset classes you need to know. At the heart of any portfolio structure are 3 liquid asset classes: cash equivalents, money market, bonds, and stocks. They differ in return, risk, and availability. And we'll use these differences systematically in the next step. A. The money market, your safety anchor. Money market investments are products with virtually no price risk. Savings accounts, time deposits, or money market ETFs. Here you earn interest but experience no price swings. Your balance moves along a stable line, ideal for securing your short-term budget. If you want to withdraw 2,000 euros per month, you need 24,000 euros for 1 year. That amount belongs in the money market. This isn't about returns, it's about stability. This bucket provides psychological safety. You know your living expenses for the next year are covered, regardless of market conditions. B. The bond market, the middle layer. Bonds are IOUs. You lend money to a government or a company. You receive interest, typically somewhat higher than in the money market. Bonds fluctuate slightly, but nowhere near as much as stocks. On average, you might expect 2 to 3% per year, depending on interest rate levels. They're perfect for medium-term funds, money you may need over the next 2 to 3 years. If the stock market is weak, you can withdraw here without risking major losses. C. The stock market, your return engine. Over the long term, the stock market is by far the highest returning asset class. You participate in the world economy, in thousands of companies worldwide. The flip side, volatility. 1 year your portfolio may gain 20% and the next it may lose 15%. But over 10 to 15-year periods, average annual returns on global equities have typically landed between 6% and 8%. Therefore, the stock market is not for money you'll need soon. It's for money you want to preserve or grow over the long term. 3. The 3-bucket strategy. Simple, logical, and proven. Many banks try to build mixed portfolios for clients. For example, 50% stocks, 30% bonds, 20% cash, or similar allocations. That sounds good, but is often hard to understand and manage. The better solution, the 3-bucket model. Here you allocate your assets by time horizon, not by complex risk classes. Bucket 1, money market, your annual budget. Everything you'll need within the next 12 months sits here. Bucket 2, bonds, the reserve for the next 2 to 3 years. You keep 2 or 3 annual budgets here, enough to bridge crises without selling stocks. Bucket 3, stocks, the rest, your long-term growth component that maintains and expands purchasing power. 4, practical example. Suppose you received 200,000 euros as a severance and want to use it to supplement your living expenses in retirement. Bucket 1, money market, 24,000 euros, your 1-year budget. Bucket 2, bonds, 48,000 euros, your reserve for 2 years. Bucket 3, stocks, 128,000 euros, your long-term growth portion. That's it. No complicated financial plan, no constant shuffling. Now comes the key point. You review the buckets once a year, nothing more. 5, review and adjust. Annually assume a year has passed. Your money market bucket is empty because you withdrew 24,000 euros. Now you need to refill it. So you ask, how are markets right now? Scenario 1. Stock markets have risen strongly. Perfect. You refill the cash bucket from the stock bucket. You realize gains and secure your budget for the next year. Scenario 2. The stock market is in a downturn. Then leave your stocks untouched and draw from bucket 2. Bonds. This helps you avoid emotional mistakes and prevents selling stocks at a loss. You repeat this year after year, completely stress-free. 6. How you get through longer. Crises, of course, there can be phases where the stock market is weak for several years, but the system is prepared for that. Year 1, you live off the money market bucket. Year 2, you draw from bonds. Year 3, you can, if necessary, draw from bonds again. Even if a crisis lasts 3 years, you remain in control. Only in the 4th year might you have to sell stocks, which historically has been rare. The major crises of the past, the 2008 financial crisis, the 2020 COVID crash, or the 2001 dot-com bust, showed that markets typically stabilized within 2 to 3 years. 7. The psychological side, stay calm. A big advantage of this method is not just the structure, but the emotional relief. Many investors don't fail because of math, but because of nerves. With clearly separated buckets, you always know. Short-term is covered. Medium-term reserve is there. Long-term money may fluctuate, and that's fine. This helps you avoid panic selling, the biggest return killer of all. And if volatility still stresses you out, just look at your portfolio less often. Once a year is plenty. Short-term prices are like weather reports. They change constantly but say little about the long-term climate. 8. How to tailor the strategy to you. The beauty of this model is its flexibility. You can easily adapt it to your situation. If you're extremely safety-oriented, make bucket 2 larger, e.g., 3 or 4 annual budgets in bonds. If you're more return-oriented, increase the stock portion. If you also have regular income, e.g., a pension, reduce withdrawals accordingly. This adaptability makes the system universal. It works for private investors, the self-employed, and retirees alike. 9. The comparison. Why mixed portfolios often underperform in practice. Traditional private banking often recommends a mixed portfolio, say 60% stocks, 40% bonds. That sounds simple but has a catch. You constantly need to decide when and how much to sell or rebalance. In the 3-bucket system, that largely disappears. You have a clear logic for when to use which bucket. This reduces transaction costs, stress, and mistakes. Many experienced investors have applied this method for decades, with great success. It's rational, proven, and can be implemented without expensive advice. 10. Conclusion. Simplicity beats complexity. The key insight: you don't need a complex system to live off your assets. With 3 clearly defined buckets, you can withdraw predictably, invest calmly, and still earn long-term returns. You review your allocation once a year. That's it. Financial planning doesn't have to be perfect. It has to work and give you peace of mind. If you like, you can run the model with a fee-only advisor or implement it yourself. Ideally, maintain a simple annual note where you record: what was my spending need? Which bucket did I draw from? And how did markets develop? Over time, you'll build routine and remarkable composure. Because in the end, money shouldn't be a problem. It should be the foundation for a good, calm, and self-determined life. I hope the video was helpful. If so, please give us a thumbs up. I would appreciate it if you would subscribe to our site so you regularly receive new videos and tutorials on investing, investment strategies, and financial products, and the world of finance becomes more understandable for you. Thanks for watching. See you in the next video.